Welcome to the Benson Wealth Podcast. I take complex financial and economic topics and make it accessible to the everyday listener. Hello, everyone, and welcome back to the Benson Wealth Podcast. My name is Drew Benson. I am the president and founder of Benson Wealth Management and a senior wealth advisor with Raymond James. I'm also the co-managing partner for True North Wealth Management Group, which is a platform for independent wealth advisors. I'm a former macroeconomist, and I'm currently a certified financial planner and wealth advisor. So today I had the distinct pleasure of interviewing economist Michael Strain. So Michael holds a PhD in economics from Cornell. He is currently a professor of practice in the McCourt School of Public Policy at Georgetown University. He is also the director of economic policy studies and senior fellow at the American Enterprise Institute, where he holds the Arthur F. Burns Chair. As an economist, his research has largely focused around labor markets, public finance, social policy, and macroeconomics. In addition to his academic writings, he's also been published in the New York Times, the Wall Street Journal, the Financial Times, the Washington Post, Bloomberg, and the National Review, among others. He's also appeared on MSNBC, CBC, CNBC, and NPR. Lastly, Michael has testified before the United States Congress. So this is another two-part interview. In the first part of this interview, Michael and I are going to talk about the Fed. Now, the sense right now is that the Fed is going to start cutting rates in September. Now, they were just in Jackson Hole this week, and Fed Reserve Chair Jerome Powell has indeed indicated that assuming things don't change with the macro backdrop, they will likely start cutting rates soon. Most of us in finance and in economics believe that the Fed should probably start lowering rates soon because the Fed is often late to the party. But not so fast. There is one guy, Michael, who believes the Fed shouldn't start lowering rates. And I do think his perspective is important and we need to hear it because he does highlight a fear of mine that if the Fed prematurely lowers rates, inflation will remain elevated. So I really enjoyed his perspective today. He makes a lot of important points, and he's making me second guess a little bit what my position is on this. Because I think the biggest fear I have, by the way, is if the Fed is indeed too early, while I think they may be too late, if they're too early and inflation remains persistent, then the Fed will be put in a position where they may have to then raise rates after they lowered them. And I do think that would really spook the markets. So I hope you enjoyed the discussion today. Michael, thanks for coming on the podcast today.
Thanks so much for having me. I'm a big fan. It's great to be here.
Yeah, likewise. So let's start. We're going to talk about two subjects today. We're going to talk about the American dream. We're also going to talk about the Fed. Let's start with the Fed because I think this is a very interesting topic. I also think it's interesting from the standpoint, as a wealth advisor, investors are watching with bated breath to see the next move with the Federal Reserve. Should they cut rates? Should they not cut rates? What should we do? Let me step back, though, first and talk about what happened during COVID, what the Fed did in response to COVID lockdowns, and then we'll get into what should the Fed do now. Mm-hmm. So I have a question for you. When the government responded to COVID with lockdowns, and to be clear, the Federal Reserve, in my opinion, did not respond to COVID, the virus. The Federal Reserve responded to lockdown measures that were imposed by state governments. Mm-hmm. And as a response to those lockdowns, they engaged in an incredible amount of liquidity injection into the marketplace by essentially printing $5 trillion. And what was unique, Michael, as you well know, about the way they expanded the money supply, unlike, say, the 2008-2009 crisis where they were providing solvency to financial institutions, they just straight up helicoptered a whole bunch of cash to a lot of American citizens. And so they flooded the market with a lot of excess reserves. So stepping back to, say, 2020, 2021, when the Fed was doing this incredible amount of injection, what was your thought on that process at the very early days with the pandemic?
Well, in the very early days, I thought it was appropriate. We saw markets kind of seizing up. And the Fed's role as lender of last resort, I think, is made a lot of what they did quite necessary. I think people forget just how difficult that pandemic recession was. Now, the pandemic recession only lasted about 2 months, and as you say, I think it was, driven in large part by the lockdowns, by the restrictions on business activity that were put in place by governments, and that were part of the advice that by state governments, and then that were part of the advice that the CDC was giving, and everything that was kind of surrounding all that. The unemployment rate, properly measured, likely went above 25%, which is just kind of astonishing when you
it is wild, huh?
And there was a very real risk that I think we were going to have another situation like the 1930s, or potentially even worse than the 30s, kind of given the linkages in global finance. And so I think the early measures that were taken both by the Fed and by Congress, I think were necessary and appropriate. And then we kind of got in this strange period where there was a lot of debate in the country about what life should be like, kind of following the spring of 2020, and different states were doing different things, and different people were doing different things, and there I think both the Fed and both monetary policy and fiscal policy, I think, engaged in some missteps in 2021. But the early
how so? Elaborate on that.
Well, I think the Fed, the Fed misjudged the nature of the. Well, I mean, you can go back even earlier. The Fed established some lending facilities that I think were poorly structured and that weren't used, like the Main Street lending facility, for example. The Fed, I think, misjudged the nature of the inflation that we were experiencing, and Chairman Powell actually in his speech at Jackson Hole on Friday acknowledged that the Fed thought that the inflation we were experiencing was transitory.
I remember that
it was going to be limited and restricted to a few sectors, and that wasn't going to prove durable, and that obviously ended up not being the case. Partly as a consequence of that misjudgment, partly I think as a consequence of the Fed's commitment to forward guidance. The Fed continued its quantitative easing program far longer than it should have, and so we were in a situation where home prices were appreciating at 20%. At a 20% annual rate, month after month after month, yet the Fed is still buying billions of dollars of mortgage-backed securities, month after month after month. Which I think was an error. And then to the Fed's credit, it really did move to correct that error and rapidly raised interest rates when the Silicon Valley Bank kind of banking crisis episode in the spring of 2023 happened. The Fed did not cut rates. The Fed did not stop allowing assets to roll off its balance sheet. The Fed placed its responsibility for returning price inflation to a low and stable level ahead of.
So they were prepared to allow a few banks to fail, right? Because Silicon Valley Bank got caught in basically a duration trap where they were owning 5 to 10 year treasuries, and then when interest rates went up, their balance sheet got obliterated. Now, obviously, there's a few other further components to the failure of Silicon Valley Bank. But do you think the Fed was aware that by raising rates, there would be some of the banks that could be exposed in that scenario that would cause them potentially to fail?
I don't. I think the Fed was broadly aware that by raising interest rates as rapidly as it did, that could cause problems for financial institutions, that it could cause problems in the plumbing of financial markets, and that it could lead to some broad financial instability. I don't think the Fed kind of specifically focused on duration risk. I don't think the Fed, was keeping a close eye on Silicon Valley Bank's portfolio. If it were, then we likely wouldn't have had the SVB crisis. But I think what's important to note is that the Fed was focused enough on the inflation risk that it didn't overreact to SVB and the related bank failings by cutting interest rates or even really by affecting its quantitative tightening program.
Sure.
And so I think I think the Fed made some pretty big missteps, but then moved pretty decisively and aggressively to correct those missteps. In terms of fiscal policy, I think the CARES Act was appropriate to the scale of the crisis that the economy was facing in the spring of 2020. Particularly given the uncertainty around what was coming and how severe it would be. But I think the American Rescue Plan that was signed into law in the spring of 2021 was a major fiscal policy mistake, and kind of similar to the Fed. I think Congress and President Biden just kind of misjudged where we were, and we were not still in a crisis, and we were in a situation in the spring of 2021 where the economy was growing, not shrinking. The unemployment rate was falling, not rising. But Congress and President Biden, still acted as if we were in this, kind of crisis emergency situation.
Correct.
And ended up, I think, substantially contributing to the inflation problem that the Fed had to solve by kind of a textbook case of pushing economic demand at the macroeconomic level well beyond the economy's productive capacity to meet that demand. And so the marginal dollar of American Rescue Plan spending, ended up manifesting in higher prices and not in greater economic output. And so we got a lot of inflation.
Do you think we would have had some level of inflation, though, right? Like, I'm sympathetic to your argument, 100%, right? I think what happened with the spending package in 21 definitely threw a lot of kerosene on the fire. That said, the Trump administration also had engaged in a large rescue package, and to my point earlier, the Fed had provided $5 trillion of liquidity to the markets. We probably still would have had a fair bit of inflation, correct, Michael?
Yeah,
even if that bill hadn't been passed.
Yeah, I think we still would have definitely had quite a bit of inflation. I mean, what factors kind of contributed to the inflation? One factor was excess savings on the part of households, and so if you look at 2020, before President Biden took office, you see that consumers really cut back on their spending, particularly in the spring of 2020, because restrictions on business activity made it hard for them to spend, and because there was a lot of concern people had about the economic outlook and the outlook for their own career and for their own family's income, and so they kind of pulled back on their spending. At the same time, Congress rushed in with $2 trillion of assistance, and so income shot way up, and so you had incomes rising up, spending falling. The gap between income and spending is obviously savings, and so households had this enormous buffer of savings going into the Biden administration, and when the economy reopened, and when people started going out again, they had a whole bunch of excess savings that they really burned through. So that was a big tailwind to demand. And I think that there was this phrase at the time, revenge spending. The idea that people really wanted to enjoy themselves and wanted to go out to dinner more often and wanted to take trips more often and wanted to go out shopping more often, and I think that really happened, and so that was also a big tailwind to demand that had nothing to do with anything the Biden administration did, and that to some extent predated President Biden taking office. Then in addition we had supply restrictions, and
Correct.
Supply chains were a little snarled and had to be untangled. Geopolitical developments led to the reorganization of some supply chains, and that restricted the economy's productive capacity, at least temporarily. There were a lot of people who were not going to work because of the pandemic. I have kids, and the situation with the school closures was just nuts, and I think a lot of people who had children or who were caring for others found it hard to work, and that kept a lot of people on the sidelines of the labor market. There were a lot of people who were concerned about COVID, who were concerned for a longer period of time than most people were. It took a while for those people to get back into the workforce. So there were supply restrictions in the labor market as well. And then we had external factors like Russia's brutal and horrible invasion of Ukraine, that led to commodity price shocks due to supply disruptions. And so you had a bunch of stuff happening on the demand side that didn't have anything to do with the American Rescue Plan. You had a bunch of stuff happening on the supply side of the economy that didn't have anything to do with the American Rescue Plan. But the American Rescue Plan, was, I think, a significant contributing factor. If you kind of think about where was the economy in the spring of 2021, relative to its underlying productive capacity. It was probably like $300 billion below its underlying productive capacity. Actual economic output was not where it should have been.
Sure.
But the Biden administration kind of poured $2 trillion of stimulus into a $300 billion hole, and that resulted in several percentage points of inflation. So I think in the absence of the American Rescue Plan, we would have still had an inflation problem. I think people would have still noticed inflation. But I think,
but maybe not 9.1% in for CPI in June.
So I think that's right. I mean, I think
definitely fuel on the fire for sure.
Yeah, I think maybe we would have capped out at in the kind of the 5s or 6s, something like that.
That's exactly where my mind went to. Yeah. Okay, so I agree with you. So let's talk about the Fed then for a second, and I want to talk about the Fed right now. Was the Fed too late, right? Like, one of my critiques, Michael, is the Fed is often way too slow to respond to things. I think historically they've struggled with that. At least that's my opinion. Were they too slow in responding to what were clear threats that we could see? Like, I felt like inflation was definitely a major risk. I didn't buy the narrative that inflation was transitory due to supply chain shocks. There are too many other factors at play, which you just touched on. Did the Fed respond too slow is my first question. Then I want to talk about what the Fed's doing now.
Well, I don't think there's any doubt that the Fed responded too slowly, and I think Chairman Powell said as much.
He's
on
admitted
Friday at Jackson Hole. I think the Fed misjudged the nature of inflation and was months behind the ball in terms of its response. Now, when the Fed realized that it had made that error, I think we need to give the Fed credit for
Agreed.
Aggressively changing course, and for being upfront about it. I mean, Chairman Powell said a couple, after the Fed began its aggressive hiking cycle, he was very clear that this could cause substantial economic pain and could cause an increase in the unemployment rate. No, we haven't really seen that yet, but he was willing to. He signaled a clear willingness to do what it took to bring inflation back down.
I agree, and I have been really impressed because it seems like every meeting he kind of always maintains a bit of a hawkish stance. Even the last few speeches, he says, look, price stability is one of our core aims, and that 2% target is something that he's been clear about. I was shocked, as you were, that when Silicon Valley Bank and First Republic, and we sort of saw those sort of regional mid-tier firms or banks failing, that they actually maintained, because that could have been a moment at which the Fed panicked, and then they decide, let's now reverse that, and that would have been a huge policy mistake. So to their credit, right, like I've been critical of the Fed, but I think it's really fair that they've done the right thing by keeping rates elevated. There was a phrase going around, higher for longer, and I was a proponent of that, and I think that has served them well, because the underlying factors of the economy have not deteriorated at this point. So now we're here today, right? So the Fed has kept rates higher for longer. They've kept the Fed window high. They're allowing the assets to mature off of their balance sheet. So the balance sheet has, I think, shrunk by a couple $1 trillion. So you're one person in a camp that a lot of economists are now calling for the Fed to lower rates. And in a recent article, you said, not so fast. I don't know if we should lower rates yet. You wrote that, I think, a couple weeks ago. What do you say today? Do you feel like we should keep rates elevated, and does the Fed run the risk of maybe prematurely lowering rates?
So I do think that's a risk. I mean, I think the Fed, I think Chairman Powell, signaled about as strongly as he could that his intention and the intention of the Fed, of the Federal Open Market Committee, is to begin lowering rates at its September meeting, and I think that is premature. Maybe I'll say why in two parts, or three parts. Part one, if you kind of like, zoom out and say where is the economy right now? I think the economy is very strong, and we still have a demand and supply imbalance, in favor of demand. Nowcasts for the current quarter of GDP, suggest the economy is growing at a 2.6% annual rate. That's above the economy's underlying potential. That will put upward pressure on inflation. The most recent retail sales spending report came in, way above economists' forecasts, suggesting that consumers are still are still consumer spending is still very strong. People are still out there spending money, more so than economists would expect. Income growth for households remains strong. Over the course of the past year, we've seen nominal wages grow faster than price inflation. That wasn't true for the first 2 years of President Biden's time in office, but it has been true for the last year. That's another tailwind to consumer spending. We still have a supply and demand imbalance in the labor market, and that labor demand still exceeds labor supply. Wages are growing. Nominal wages, continue to grow at a rapid pace. Layoffs in the economy are trending down, not up.
That's interesting, isn't it?
Yes, and the unemployment rate is still quite low. I think a lot of people looked at the July labor market report and saw that the unemployment rate increased by 0.2 of a percentage point, and that spooked a lot of people. And
it did.
But I think if you look at the details of the report, that's an unemployment rate increase that's driven by a boost in labor supply, not a reduction in labor demand. And so you had 400,000, roughly 400,000 people enter the workforce. They didn't all immediately find a job, and so the unemployment rate went up. If they all find a job, the unemployment rate is going to go down. And so kind of the picture of the labor market, the picture of the real economy, looks like an economy that is strong. It's not as strong as it was 2 years ago, but that was the whole point of raising the funds rate to 5 3/8% was to slow the economy down. And so the labor market has softened, but it isn't soft. Consumer spending has softened, but it isn't soft. If you look at financial markets, they don't look particularly tight. We've had 20% growth in equity prices over the past year. The bond market, expecting a whole bunch of cuts in the federal funds rate, yields are relatively low. The Fed's goal in raising and lowering its policy interest rate is to affect broader financial conditions, and broader financial conditions are look to me on the looser end rather than on the tighter end, which suggests that a 5 3/8% federal funds rate may not actually be as restrictive as people think. And then finally, if you look at price inflation, it's of course the case that inflation has come down quite a bit, but I think that there is still a very real risk that inflation gets stuck above the Fed's target, and not by a little bit. I think underlying inflation in the economy right now is 2.6, 2.7, 2.8%, something like that, whereas the Fed's target is 2%. And I think there's a very real risk that inflation gets stuck at 2.6, 2.7%, which I would view as an unacceptable outcome in the absence of significant labor market deterioration, which we're just not seeing. And so that's kind of where I think we are. That's part one of my answer. Part two is there are two, in a very kind of pragmatic sense, there are two important data points that will materialize between now and the Fed September meeting. One is the August employment report, and one is the monthly consumer price index. it seems very, very plausible to me that the unemployment rate will be lower in August than it was in July, and that the consumer price index will be firmer than it was the previous month. And so, the Fed has made a really big deal about being data dependent. The July data, I think, spooked people, but
it was one data point. You actually made a point. You made this point in an article you wrote that I read this morning, and I made the same point on this podcast and in an article that I wrote, that one data point is not a trend; it's a single data point.
Yeah, I think that's
right. And then the context too. I just read this article the other day that a lot of the people that have entered the market looking for jobs was actually due in fair part to immigration as well. And listeners need to understand that unemployment is predicated on the number of people that are looking for jobs. So if tomorrow all these people stop looking for jobs, the unemployment rate would come down. So we have to contextualize what it means. If unemployment rate was going up, to your point, because there was massive layoffs, then we'd maybe all grow a little bit more concerned. But the reasons that there's unemployment is not concerning. And then secondarily, it's a single data point. And so I'm not going to make massive sweeping decisions on client portfolios because I got one bad report when it went up 0.2%, right, Michael?
Yeah, I think that's exactly right. And I think it will be, imagine it went down 0.2%. The unemployment rate goes down 0.2% in August, which I think is completely within the realm of possibility. And that'll make, if the Fed does begin the kind of cutting cycle in September, it'll make it hard for the Fed to explain that. And then, finally, the Fed has to be a little bit forward looking. And we are going to have a new president in 2025. 2025 is about 3 months from now, so it's not that long from now. And there's a pretty high likelihood that we're going to have some fiscal expansion in 2025. That the budget deficit will increase rather than decrease in 2025. And that I think is an important consideration. The Fed cuts 50 basis points in 2024, which is less than the market expects. That will presumably accelerate the economy going into a year when fiscal policy is going to accelerate the economy. And so, if the Fed does cut in September, which I think it almost surely will, I would encourage Chairman Powell and the Fed to be quite clear that a cut in September doesn't rule out increases in 2025 if increases are in fact necessary. But if that kind of caveat is required, then you kind of got to ask yourself, what's the point of doing it at all?
Yeah, one of the things that we'll transition here to the American dream, but one of the things that I think concerns me too is, operating in the financial markets, everyone is just clinging to everything that the Fed says, and I think much movement is based on, forward-looking expectations on what the Fed will do, and so people price it in. It's not like financial markets wait around. It's definitely a leading indicator. And so if the Fed lowers rates and inflation remains persistently high due to maybe fiscal stimulus that's excessive next year, and then the Fed has to go back in and raise rates, that'll spook the markets in a very real way. Yeah. And then I think you start to run that risk. I think I'm a little concerned that they may be too late, but I think a bigger worry of mine isn't that they're too late in lowering rates. My biggest concern is they have to go back and re-enter and raise rates kind of the way they did throughout the 70s in particular, and that was not a particularly happy and healthy time economically for the United States economy.
No, I don't think it was. And I think it'd be fine, I think they just need to if it would be fine to be in a world where the Fed did not rely so much on cycles and where it was not obvious to everybody, months in advance,
Exactly.
what was going to happen. In terms of the direction of travel, I think there's uncertainty right now in markets about how much easing there will be over the next 3 months. I think there's uncertainty about whether the Fed will cut in November, or will it take November off? These are the sources of uncertainty. But markets are placing no weight on the possibility that the Fed would raise rates in 2025. In 2024. And markets are, in fact, I think placing very little weight, if any, on the possibility that of the remaining 3 meetings, the Fed won't cut in at least 2 of them. And that's, I think, not the world that we should be in an economy with above target inflation, and an economy where economic growth is above its underlying potential. And so, if the Fed kind of prepared markets and said, look, 5 3/8 is restrictive, we're going to cut by a quarter point, we're still going to be in restrictive territory. We think that there's a chance that we're going to keep cutting. We also think there's a chance we're going to raise, and you guys are, we're not going to hold your hand through this.
Yeah, you're over your skis, people.
Yeah, then people, I think investors would adjust to that world. But the risk that you put forward is a very real risk, which is that the Fed is so used to providing this kind of forward guidance and holding the market's hand, that we're kind of back to a situation like the one we were in when the Fed kept buying mortgage-backed securities despite the fact that the housing market was on fire, because they kind of felt like they had to, because they told everybody they would.
So true. So true.
And that's not a good place to be.
There's an unhealthy relationship between Wall Street and the Fed right now. It's a dysfunctional one that I think needs to maybe we need to get a divorce attorney on the line here.
Get a marriage counselor.
That's right. Great stuff, Michael. If you've enjoyed this content and you're looking for a wealth advisor, or if you're a financial advisor and you're looking to make the jump to the independent side, please message me on LinkedIn, or you can email me at drew.benson@bensonwealthmgt.com. Lastly, you can call my office at 603-316-2544. Securities offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Benson Wealth Management and True North Wealth Management Group are not registered broker-dealers, and they are independent of Raymond James Financial Services. The foregoing information has been obtained from sources considered to be reliable, but we do not guarantee that it is accurate or complete. It is not a statement of all available data necessary for making an investment decision, and it does not constitute a recommendation. Any opinions are those of myself and not necessarily those of Raymond James. Expressions of opinion are as of this date and are subject to change without notice. There is no guarantee that these statements, opinions, or forecasts provided herein will prove to be correct. Investing involves risks, and you may incur a profit or loss regardless of strategy selected.